Hey traders, welcome back to Intraday. Did you know that over 90% of major market moves happen during specific time windows throughout the day? If you're not trading during these key moments, you're probably missing out on the highest quality setups. In today's video, we're diving into one of the most important factors in intraday trading, timing and kill zones. Understanding these zones can significantly improve your trading strategy and timing. If you're looking to make your trades more precise and profitable, stick around. So let's jump in. What exactly are kill zones? Kill zones refer to specific time periods in the trading day when the market sees the most volatility, liquidity, and institutional activity. These are the times when major players like banks and large financial institutions are most active, often pushing price around before committing to a strong directional move. By focusing on these windows, you can avoid getting caught in fakeouts and low-volume traps, and instead take advantage of moments when the market is truly alive. In short, timing is everything, especially for day traders and scalpers. When we build our strategy around kill zones, we narrow our focus to the most active parts of the day and filter out a lot of noise and risky setups. So always remember, first comes timing and kill zones, then we analyze price action to spot trade opportunities. Kill zones are typically aligned with the three major trading sessions: Asian session, London session, and New York session. There are four primary kill zones we'll be discussing today: Asian kill zone, London kill zone, New York kill zone, and London close kill zone. Each of these zones corresponds to different global financial centers, and understanding them can give you a real edge in your trading. Asian kill zone, 8 p.m. to 12 a.m. London kill zone, 2 a.m. to 5 a.m. New York kill zone, 7 a.m. to 10 a.m. And finally London close kill zone, 10 a.m. to 12 p.m. Consider kill zones as a time window with a high probability of winning within a session. Before we dive deeper into how price reacts in each of these kill zones, we need to cover something even more important: market phases. The market always moves in cycles, and understanding these phases helps us anticipate what's likely to happen next. There are three main phases: accumulation, manipulation, distribution. Think of this as a continuous loop. The market repeats this cycle again and again. Accumulation is when price moves sideways, usually in a tight range. Then comes manipulation, where the market grabs liquidity, often stopping out retail traders. Finally, we get distribution, where price moves directionally, creating the real move of the session. This repeating pattern is known as the power of three. It's like the heartbeat of the market. Now here's how it typically plays out across the forex kill zones. Asian session is usually the accumulation phase, where price consolidates. London session brings the manipulation, often forming the day's high or low. New York session delivers the distribution, with a clean move in one direction. And finally, the London close is often used as a profit-taking window, where price locks in the day's high or low. But here's a pro tip you need to remember: if price expands during the Asian session instead of accumulating, then you shouldn't expect manipulation in the London session. Instead, London may start accumulating, and that means the New York or London close sessions are more likely to handle the manipulation and distribution. So always start your analysis with the Asian kill zone. It sets the tone for the entire trading day. What happens there can tell you a lot about what to expect next. As for timeframes, the 15-minute chart is ideal for spotting these patterns. It gives you a clear view of market structure while still aligning well with higher timeframes. Before continue, I want to introduce you to a new and exciting project that I recently came across. I've been researching some promising projects for this cycle, and I just came across something that could be a real gem for the next bull run. It's called Nomi Finance, and honestly, it's got me pretty excited. Let me show you why. First off, here's their official Twitter account. You can follow them at Nomi Finance on X. They've been really active lately, sharing updates and insights about the project. Next up, let's dive into the white paper. You can find it on their website or directly at Nomi White Paper. Here, I just want to give you a quick overview. Roadmap: it's well defined, focusing on building a robust ecosystem. Contact and team. You can see the transparency here, which is always a good sign. And tokenomics. The NOMI token has a well-structured allocation, which shows they've put a lot of thought into sustainability and growth. Now, let's check out their official website, NOMI Fee. NOMI is essentially a global platform designed for growing and managing digital wealth. It's all about strategic ventures and providing advanced tech solutions for users. Let me show you the most important part, the NOMI token page. Go to NOMI token. This is the heart of the project, and the utility of NOMI within the ecosystem is pretty impressive. Alright, I'm about to make a live purchase. I'm logging into my NOMI account. I'm going to buy around $4,000 worth of NOMI tokens right now. And there we go. Transaction complete. I'm officially on board, supporting the project, following it closely, and now personally holding NOMI. I really believe in the fundamentals of this project. The team behind NOMI has been involved in launching hundreds of successful projects, and now they're releasing their own. That's a big deal. I see strong +10 potential this year, but of course, nothing is guaranteed. Let's see where this goes in the bull run. So guys, never invest money you can't afford to lose. The crypto market is volatile, and you should do your own research before making any financial decisions. I genuinely believe in the fundamentals of this project, but it's crucial to remember that there are no guarantees when it comes to investments. Even though I find this project interesting and promising, always make sure to do your own research and understand the risks. Let's walk through a common scenario using a bullish market profile. Price enters the Asian session and begins consolidating within a tight range. This is the accumulation phase, a period of sideways movement, where the market is essentially preparing for the next leg. Then, at 12 a.m. Eastern Standard Time, the New York opening price prints on the chart. This becomes a key reference point. As we enter the London session, we expect manipulation. Typically, price will dip below the Asian range, tapping into a previously identified PD array, that is, a price delivery array like a fair value gap. Order block. Breaker block. Mitigation block. At this stage, price has gone through both accumulation and manipulation, and is now primed for distribution. Now let's talk entries. If you prefer an aggressive entry, you could enter a long position directly from the PD array below the New York opening price, anticipating the start of the distribution phase. If you prefer a more conservative approach, wait for a clear market structure shift following the manipulation. Once that happens, look to enter from the optimal trade entry zone or any newly formed PD array within that structure. As price begins to expand, we now move into the distribution phase, the bullish move we've been waiting for. This setup represents the ideal ICT bullish scenario. Price forms the daily low during London via manipulation, then pushes higher during New York as distribution unfolds. Now here's what to watch for as the New York session progresses. By 8:30 a.m., when major economic data and market volume hit, one of two things usually happens: reversal or continuation. In most cases, the market will continue in the same direction established by the London session. But if price has already reached a higher time frame draw on liquidity, then a reversal becomes more likely around the 8:30 mark. If price hasn't yet hit that draw on liquidity, we can look for another buying opportunity, again from the OTE zone or any new PD array, with the aim of targeting that higher timeframe liquidity level. And finally, London close kill zone. This zone often acts as the final profit-taking window. Price frequently sets the high or low of the day here and then begins to pull back, retracing from the higher timeframe draw. From Asian session to London close, this entire structure, from accumulation to manipulation to distribution, represents the key price behavior to watch in your daily market analysis. Study it, track it, and eventually, you'll start to anticipate it like clockwork. The daily opening price is established during the Asian kill zone, typically right at midnight New York time. From there, the daily low is most often formed during the London kill zone, while the daily high and daily candle close usually develop during the London close session. So, traders, this gives us a standard framework for how price tends to behave throughout the day. More importantly, it shows how key concepts like accumulation, manipulation, and distribution play a role in our daily market analysis. Now let's break down some key points and pro tips you should always keep in mind. Alright, back to the tips. When trading the New York kill zone, aim to enter buy positions below the midnight opening price and the 8:30 a.m. price level. These points act as liquidity magnets and offer strong positioning for bullish setups. Number 2. Always give priority to trades that set up within kill zones. These zones offer the highest probability setups because they align with institutional activity and major liquidity events. While it's possible to find setups outside these windows, they tend to carry more risk and less consistency. So unless your trade is built off a structure or liquidity event that began within a kill zone, it's generally best to stay on the sidelines. These kill zones aren't just time markers, they're a map of the market's heartbeat. Understanding them gives you the edge you need to execute with precision, confidence, and consistency. The framework we covered is simply a roadmap. It helps you understand the logic behind price movement and how liquidity is targeted throughout the day. Now let's move on to the charts and apply what we've learned. On the screen, we're looking at the pound on the 15-minute time frame, a great view for spotting intraday setups and kill zone behavior. Before analyzing market structure or drawing any levels, the first thing we'll do is highlight our kill zones. Now that the zones are highlighted, we can start dissecting price behavior within each one step by step. Let's see how the market reacts at each stage, and how we can use this insight to plan our trades more effectively. Now that we've marked all the kill zones, let's break down the price action step by step. As we move into the Asian session, price begins to consolidate within the kill zone. During this period, volume and volatility are low, which is typical of the accumulation phase. Once the New York midnight price opens, we start to see momentum build. Price drops above the Asian range, sweeping buy-side liquidity. This move completes the manipulation phase, taking out stop losses and triggering buy stops of traders who entered during the Asian session. Then, as we enter the London kill zone, price moves upward with momentum and then quickly reverses after this move. This sudden shift in momentum breaks below a recent swing high, creating a clear market structure shift. At this point, we've now completed both accumulation and manipulation, and price is signaling entry into the distribution phase. Notice what forms here: a 15-minute PD arrays, specifically, a mitigation block and a FVG. This structure is a clear sign of smart money involvement, and the mitigation block becomes a high probability zone for a short position. Why? Price completed the accumulation phase in the Asian kill zone. It completed the manipulation phase just before or during the London session. It formed PD arrays, the mitigation block and FVG, inside the kill zone. The trade setup aligns below the New York midnight price, which is a critical entry criteria. And most importantly, it all happens within the kill zone, where the probability of success is significantly higher. With all conditions met, you could have placed a sell order at the top of the mitigation block and FVG. Eventually, price reaches the London close, our key profit-taking zone. From there, price taps into higher time frame buy-side liquidity, triggers a retracement, and pulls back into the close of the day. So traders, this is how you apply the framework to analyze price behavior, map market structure, and execute trades with precision. When you use this method consistently, you'll gain a clearer outlook on what price is likely to do and, more importantly, why it's doing it. It helps you focus on high probability setups, eliminate unnecessary trades, and build a trading routine grounded in timing and market logic. That's it for today's video. I hope you found it insightful and practical. If you did, be sure to subscribe, hit the notification bell, and leave a comment below to let us know what topics you'd like us to break down in the next episodes. Your support means a lot. Thanks for watching, and I'll see you in the next one.